You're listening to the Economics and Country Risk podcast from IHS Markit. In each episode, our experts will provide you with a clear 360-degree perspective on what's happening around the world.
Welcome, everybody. My name is Emily Crowley. I am an Associate Director of Pricing and Purchasing with S&P Global Market Intelligence. Today, I'm taking over for John Anton and hosting the Economics and Country Risk podcast. Recently, we have seen a lot of news about labor markets, especially coming out of 2022 and into 2023. The uptick that we've seen in things like strikes, labor disruptions, higher wages, shortages, not being able to fill positions. This has become a major headache for employers. Essentially, employers are going out to the market. There aren't enough workers. If you are able to get a worker, you're looking at significantly higher wages. And if after all of that is done, you are still experiencing some pretty large disruptions from strike actions, which have in some cases been affecting entire sectors of the economy. So as we enter 2023, I'm joined by Sophie Malin and Sam Parkin, both of who are senior economists with pricing and purchasing, to discuss some of these trends. So Sam, Sophie, thank you for joining me today. All right, Sam, I want to start with you. Europe has been grabbing headlines with the uptick in strike action we saw through 2022 and really even to the beginning of 2023. I'm curious, what is the current labor market situation in Europe?
Hi, Emily. The labour market across Europe is still very tight. It was tight in 2022, and this is because of the pandemic mostly. Workers migrated back home as the borders closed, and as a result, there are large vacancies, labour demand is high, and there's not enough labour supply, so there's not enough workers to fill these positions. Currently, we're seeing a weakening demand, but still high demand. Firms are reluctant to lay off employees because of the struggles they've had in getting employees. As a result, they're retaining these workers. So vacancy rates, they remain high. The unemployment rate isn't necessarily rising either, which suggests that employers are retaining these workers. So moving forward, we're anticipating slower economic growth. Now, there's been a lot of talk about recessions within Europe. This is seemingly going to be a bit less severe as previously anticipated. So we still anticipate labour demand to be high. We anticipate vacancy rates to remain high. They have gradually decreased, only slightly. So moving forward into 2023, we still anticipate a tight labour market.
Got it. So it seems like right now we have this gap in demand. We'll start to see economic growth start to slow, but because we kind of have this backlogs in hires that we don't necessarily expect to see the mass layoffs that we might have seen, coming out of the Great Recession. And I think that's pretty much on par for our expectations for the US as well. And it does seem to be kind of a developed economy trend that coming out of the pandemic, there was this burst of demand. We've really fallen short as far as finding the available workers that are needed to fill those positions. It's put upward pressure on wages. It's created shortages. And this is, again, more from a U.S. economic perspective. There's lots of headlines right now about layoffs in the tech sector. But if we look at some of the underlying data, really most of the other sectors of the economy have continued to add jobs, even ones that you would expect to be adversely affected by the current interest rate environment that we're in right now. And I would say that same thing for the US. Labor market conditions are going to remain challenging in 2023. They'll be improving, but we still have this fundamental gap and shortage in labor markets to be able to clear demand. So, Sam, I want to come back to you because, of course, inflation has been a buzzword really for the past 18 months. We've seen inflation reach historic records, and we've been seeing a lot of pressure coming through from workers, like you mentioned, to see labor cost increases. Europe in particular seems to have a significant challenge with inflation. It's running even higher than what we see in the US. So what are you looking at in 2023 as far as labor costs?
Well, we're seeing a reduction in natural gas prices at the moment, which is great for inflation. However, we're seeing a continued escalation in food prices, and I think that is an issue. I think that 2023 is still going to have strong inflation because of these food price increases. As a result, there'll still be strong wage pressure from the unions, from collective agreements, and so as a result, you'll still have this upward wage pressure.
Yeah, so it sounds like inflation environment will be improving, but we'll still continue to have pressure on wages because of this overarching theme of now we have some labor agreements that have locked into stronger escalation rates, and then still wages seem to be catching up on the inflation that we saw last year and are not necessarily reacting to the cooling off that we're starting to see. So, Sophie, so far we've been focusing primarily on developed economies, but one of the big news stories of 2023 has been the reopening of Asia. So, obviously, Asia, mainland China is the world's manufacturing floor. There was huge disruptions, but what are you expecting as far as labor conditions? Are we going to see the same boom in demand that created labor shortages in the US and Western Europe? Or do you think that mainland China and the surrounding economies are in a somewhat better position?
Well, the labour shortages haven't really built to the same extent as they did in North America and Europe. So labour shortages are there, but they're not as severe. So this was very much because the worst of the pandemic hit the region later than it did America and Europe. So there's not been as much time in the region for these labour shortages to rebound before these more challenging economic conditions that have started to come through and started to suppress that labour demand. So it's an issue, but it's not as much of an issue. And I'm not saying that there aren't labour shortages. There certainly are, and it is an issue in pockets of the region. There were labour shortages prior. So it's a case of the conditions are not quite as severe. So there's not as many labour shortages as we're seeing in other regions. And so there's not quite as much pressure on wages to grow. But that's not to say that there aren't areas of difficulty. There certainly are. And Australia, for example, really stands out as a country that's suffering from labour shortages. And as a result, we're seeing quite strong growth come through, and that's going to even strengthen further in 2023 as a result.
So, Sophie, circling back to mainland China and the reopening that we've seen recently, there have been upticks in outbreaks. What are some of the concerns from a labor markets perspective that you see going into the Lunar New Year and then beyond?
So with the reopening of the Chinese economy has come a wave of COVID cases. Of course, very much expected, but that's increased absenteeism within the workforce, and so this is causing labour shortages. If we take, for example, the manufacturing industry, we've seen reports of up to half or 3/4 of workers not being available due to COVID. And then added to this, we've then got the difficulty of the Lunar New Year holidays. So we normally typically see labour shortages around this time of the year, but we're expecting it maybe to be more severe this year because now there's more propensity for migrant workers to go back home and celebrate. And so it's just going to take those labour shortages that are already happening and just make them even more severe. So that's the really immediate issue that we're seeing in terms of that reopening of the Chinese economy and its impact on the labour market. I will say there is some opportunity with it, and that's opportunities for other countries. So there's a number of countries that actually rely on China as a source of their migrant labour. So we're talking Singapore, Japan, for example. And now that these Chinese workers are coming online again, it's expected to help soften the level of labour shortages that are in these countries. So immediately not great impacts on labour availability in China, but it could be an opportunity for other countries that are struggling with labour.
So I think it's really interesting that you're talking about some of these other Southeast Asian countries and the opportunity there, because one of the things that we saw following the pandemic, and really was a pre-existing trend, pre-pandemic, post-tariff increases on Chinese imports, is restructuring and reorganization and rethinking of global supply chains. So whereas a lot of firms had been single sourcing from China, now we're seeing that there's been a push towards diversification. Is that also playing into labor market conditions in Southeast Asia?
Yeah, absolutely. As you say, the pandemic really exposed that reliance on China as a production source. Of course, restrictions as well related to COVID were impacting production levels in China. And so there was a further need to diversify supply chains. So what's happened has been a reduced demand for Chinese labour, and then it's pushed that demand to other Southeast Asian countries. So countries like India, Vietnam, Thailand, they've been major recipients of this diverted production. And so what this has meant is obviously stronger demand for labour in these countries and then stronger wage growth pressures. Vietnam's actually expected to be one of the hotspots for economic growth over the medium term due to this diversification of manufacturing demand. So it's softening the wage growth pressures in China as a result, but strengthening them in the recipient countries.
So interesting. It truly is a global economy, isn't it? So before we close, I would like to ask both of you, what are you going to be keeping an eye on for 2023? So Sophie, I will kick off with you since you just answered my question, and then we can turn to Sam.
Yeah, for me, things to really keep aware of and keep an eye on is vacancy rates and the unemployment rate. So we're expecting the unemployment rates across countries to increase, obviously, as labour demand softens, and therefore also vacancy rates, so number of unfilled jobs, to soften, so to decrease. If we don't see this, then we're not really seeing that rebalance of the labour market that we're expecting. And so this will be something that might indicate to us that wages aren't going to be on that downward path quite yet. So that's what I'm going to be looking out for, making sure, we're seeing that increase in that unemployment rate or the decrease in vacancy rates to suggest that we're going to have this rebalancing and a softening of wage growth.
Got it. So it's as much availability, but also the cost pressures that employers are facing, right? So that's going to be one of the keys to starting to see inflation coming down. We are dangerously close, I would say, or characterize it, to a wage inflation cycle. I won't say that we're there yet, but it does seem that, one of these things has got to give. Our expectation is we will start to see a softening in labor market, and that will take some of the pressure off of labor costs. But if that doesn't happen, right, that's a little bit of a red flag. Sam, same question for you. What are you keeping an eye on?
So I'm going to say two things as well. So the first one being inflation. I think it would be very interesting to see how it develops. Like I said earlier, with natural gas prices falling, this potentially could mean that inflation falls, and that's what we're seeing at the moment. However, food prices are remaining elevated and they're continuing to rise. And so if we can see some kind of fall in that, then wages will follow. The second thing that I'm going to say is union deals, really, and how they're reacting to inflation. We've seen some deals like the Felixstowe port wage deal that got 15.5% across 2 years. Now that's not strictly keeping up with inflation, but close. If it's the same across each industry or whether it differs between industries, I think that would be quite interesting.
So really kind of using those union agreements as a coincident indicator of whether or not we're starting to see that pressure coming off.
Yes, exactly that.
So for me in the US and even Canada, I'm also keeping an eye on our vacancy rates and then some of the layoff announcements. So like I mentioned earlier, we are starting to see some headwinds to growth and to labor market demand, primarily through higher interest rates. Typically hits the manufacturing sector and the construction sector, which has been interesting, at least during this part of the cycle, has been that, again, most of the layoffs that we've seen seem to be in response to a normalization in consumer demand post-pandemic. These tech companies that doubled their labor forces during the pandemic are starting to see some curtailments, and we've seen layoffs there. What's interesting is that we have not seen that on the manufacturing or the construction side, which typically is where we would expect that. And again, I link that to the shortage issue that, especially for construction and manufacturing, we're talking more about skilled workers, and these workers have been part of the aging skilled trade workforce in the United States. So that's kind of where I'm keeping my eye on, is if these sectors don't end up having any sort of adjustment, it really does point to continued tightness in this labor market shortage and that kind of real economy, at least goods producing economy. I see significantly less pressure coming through on the services side. We did see strong wage growth, but it looks like that's at least stabilizing and starting to slow down. But again, we have in the United States this continued issue with not enough skilled workers, which I have been talking about for decades at this point. And it seems that we have not really made any fundamental changes to improve upon that situation. So for anyone in the manufacturing sector, construction trades, energy, oil and gas, definitely something to keep an eye on. But elsewhere, definitely some room for opportunity. Sam, Sophie, thank you again for sharing your insights with us. This was a really interesting conversation. We touched on a lot of different aspects of global labor markets. They are connected, they are complicated. This has been a very difficult environment, especially for employers, just again with the availability issues, the price issues when we're looking at wages, and then also from disruption. So it sounds like 2023 is going to continue to be a challenging environment, but hopefully things will start to improve. So also thanks to our listeners for tuning in. If you'd like more information, please visit our blog, follow us on Twitter and LinkedIn, and subscribe to this podcast. We will dive deeper into forces at work in 2023 in upcoming episodes.
Thank you for listening to the Economics and Country Risk podcast from IHS Markit. Connect with us on Twitter at Economics Risk. And don't forget to sign up for our newsletter at ihsmarkit.com/ECR.